it's just going to be a drag. That's kind of the point that I was making, is that this is not necessarily a risk on spread. It's a safe haven trade. So that doesn't mean that indices are going to scream higher. It just means that it's not going to rally really easily. And when it breaks, it's going to be fast and furious.
And I want to start off looking at the bonds packs. You've got your levels. I want to get right into it this morning with the bond market. He talks about if the 30-year gets above 5.25%, that's something we'll have to keep an eye on. Obviously, for us watching the futures markets, you're not going to know the handle of the yield. You could actually look at the handle for the 30-year. There is a micro product for it. But ultimately, if we start breaking lows in the 30-year bond with any sort of momentum, that to me is what's going to trigger of what Nick's talking about. What are you looking at in bonds?
I was trying to figure that out, where bonds would be if we were at 5.25, 5.30. We're trading at 112.20. That'll take us down to 107, maybe 105, 106 on the 30-year bond handle. We're already in that range of prices that we have not seen the 30-year bond since the 2000 evens, going back into the 90s. I think that eventually we see a 9 handle print in the 30-year bond before it finds a bottom. So I think we've got a long way to go, at least technically speaking. Fundamentally, and what the Fed ends up doing, or bond vigilantes, or whatever kind of bottom the market can find because of capital flows, is a different thing. But technically speaking, from a tradable standpoint, 113.24 in the 30-year bond, which is the level I've been talking about, on our show since the beginning of the year, really. Going back in 2014, 2007, and I think around 2000, is an incredibly pivotal price. So 113.24 is ultimately where I want to be long above and short below. And then underneath 113.24, the 30-year bond is going to trade down to where we are now, 112.17. This is another little pivotal area. 113 to 17 is a pivotal area. Underneath there, then we start attacking some more recent lows, 111.23, and then we're down to 110 even, 110.02, which is the low of the year. That takes us to the high yield on the year, which is what is that, like 5.1, 5.2 almost? Somebody asked a second ago in the chat to translate what Nick said. He's not especially bullish. What he said is that he's not especially bullish U.S. stocks in the long term. That doesn't mean that we don't rally another 100 points, 200 points, but there's a lot of drag here, and the 30-year bond going lower is going to continue to drag on equities. And that doesn't mean that we break right away. It doesn't mean that you go out and sell a rally. It just means that that the equities, the indices specifically, are going to have a bit of a difficult time rallying, especially with weakness in the dollar.
Yep. So let's talk about that too with the bond market. And here's the one thing that Pax and I have talked about a lot, is that the bonds always matter, but they don't matter to equities until they really matter. And I think that's what comes down to what Nick had talked about today. You got 5.25%, he says, is a threshold where if you start seeing 5.30, 5.40 in the 30-year rates, and he's saying it's the highest real rates we've had since 07. What gets interesting is that if the bonds, again, anytime the bond market moves with velocity, right now we've been in a range. We are seeing them at the lower part of the range, nearing some of these key levels that Pax is talking about. We still have to trade level to levels, as Pax will go through with all of us. But if the bonds go down with velocity, that starts to change things within the entire, financial system. And that goes back to what Nick is talking about. It's like, and then at that point, they really matter to equities. And he's saying ultimately right now that, why would you want to buy anything with the dollar going lower? Why would you want to buy the bond market, right? I mean, he's talking about JP Morgan, Jamie Dimon, him being bearish. And that ultimately is going to be bullish. As the dollar goes down, you're going to buy things that are going to be worth more with the dollar going down. So the people are buying equities, people are buying Bitcoin, people are buying gold, people are buying euros. So that's what he's saying is the trade. So he's saying that equities aren't necessarily going up because, the market wants to own more equities. They're going up because they're moving out of dollars and they'd rather own equities. And until the bond market breaks something, that's a place they'd rather be versus holding dollars. Hopefully that helps people.
It's just going to be a drag. That's kind of the point that I was making, is that this is not necessarily a risk on spread. It's a safe haven trade. So that doesn't mean that we're going to go that indices are going to scream higher. It just means that it's not going to rally really easily. And when it breaks, it's going to be fast and furious. We're not, stagflation, no, but we can sit here and churn this. The indices can sit here and churn this area now, make another high, and then kind of sit in this range now for a while until the bonds break something. And we were talking about that during all of the tariff mayhem that we had in the end of the first quarter, beginning of second quarter, was the bonds breaking something. As bonds just continue to go lower, and when is something going to break here? That's such an interesting thing, and I think we have to bring gold into that conversation too. One of the things that Ira Harris has taught me and you through the years is that gold is not really a hedge against inflation as much as it's a hedge against central banks losing control of monetary policy. And we've seen gold. I don't even know what the percentage change on it is for the year. Gold opened the year at, let's see, at 2641. So, just to give you a little perspective between, the movement between gold and the bonds, is that the bonds opened the year at 1324. So a point and 4 ticks lower. Gold opened at $26, $800 lower than where we are now, and that is an obvious sign that everybody's looking for a safe haven. And equities have rallied. 59.49 is where equities opened the year. We broke down to 48.34, and now we're at 62.85. I mean, it's a crazy, crazy place. And there's still so much capital out there that, that continues to pour into the market to at least hold it up. That once that rug is pulled, man, it can be difficult. I don't know. That's all my opinion. I'm going to continue to trade the market as it is and not as I think or want it to be. And I'm going to trade my markets level to level to level. And that's just like I outlined in gold the other day in our show on Friday.
Yeah, let's start off with let's go through the gamut today. Let's get into some intraday analysis, what we're looking at coming into today. Let's start with NASDAQ. I've got the NASDAQ chart up. A little bit of a gap overnight. I said the market's kind of yawned at this news with this 30% tariff. And again, to me, I see a market down 0.5% or whatever it is. The NASDAQ was down minimal, and of course it just grinds back up like that. That's news that's not really derailing this tape. The market probably had some weekend and longs over the weekend, and you see some sellers come in, but we're right back in this gap. What are the key levels we're going to be looking at this morning in NASDAQ?
23,109. It also is a couple of ticks off the high, but 23,109 is ultimately it's the macro level, the upside target based off of the quarterly pivot, which is 1,000 points below where we are, 21,889. So that gives us an upside target of 23,109. That's one of those levels I talk about that won't change. It'll be a target in my plan in 10 years, 20 years when we trade back to it. So that's going to be, like, think of it as kind of a magnetic number, right? When the market rallies up to it, the magnet will pull it up. And when we achieve it, we either get above it and run and extend, or we churn it. And right now, we're just churning it. We're churning below it. Rallied up to 23,102 or something last week. So underneath there, then we've got last week's low that we need to take out, which is the pit low. I don't really care much about the all session low. I want to see, or regular trading hour low. It's something I still call the pit low, which is going to be down to 22,000. Remember this, sevens, okay? 22,777. The low is 22,779, but I'll remember it in 3 sevens because that's my lucky number. It's God's number. So 23,777 underneath there. Then we can break down to, to early July lows, another 100 handles. And then the macro level on the downside, 22,445. So 22,445 won't change, and 23,109 won't change. And in between that will be the range. I'm not going to be excited about being long until we close twice above 23,109. And I'm not going to be excited about being short until we close at least once with 2 closes below 22,445 for me to get excited about the short side.
And, I look at these levels here, Pac. So those two are the two key levels, and you can see NASDAQ is boxed in. And here's the one thing I want to talk about with you just for a quick second. If we were to see news drive outside of those prices and then hold above or below those prices, that's when you start to think that we're breaking out of this range. Until then, a lot of what's happening within those areas, 23,109 down to 22,777, like you talked about. Basically, you're looking at two-way tape intraday for short-term day traders. Focus on their short-term strategies. Of course, you would opening range, but that's the play.
Yeah, that's it. Until we close below 23,777, and then we need confirmation underneath 445 for the sentiment to change bearish. But until we close below that, we're stuck in a range. Trade it accordingly. The less we trade, the happier we're going to be. Take it easy. Just simplify this. We make it so much harder than what it really is, Anthony. I know you and I have always done that, and I see it constantly on Twitter. Every day as a trader should feel like you're cheating life. Every day should feel like you're on vacation.
Look, you've done a great job at that. It takes years of experience, and really, I think one of the number one things that I think is a positive mental attitude every day is the only way that you're able to even achieve that on every level, because negativity creeps in, FOMO creeps in, seeing people. It's funny. I was thinking about this the other day. We talk about how 95% of the traders fail, but if you watch us, 95% of the traders are making millions of dollars. It's kind of it's a totally different concept, and it totally takes people away. And to me, it's that negativity seeps into the marketplace. But let's go to the S&P, because I want to get to S&P and gold before we move out of our segment this morning. Those key levels, I think, are very helpful in NASDAQ to understand. What are we looking at in S&P right now?
The S&P is almost untradeable, like except from like a 15 handle rotations and the 15 handle rotations I talk about from the opening range. And we only get those a couple of times a week. So simplifying everything for, at least from my standpoint, opening range breakouts for 5 to 10 points. So the major levels in the S&P to pay attention to are going to be a 6206 on the downside is the macro level, so 6206. Now, I don't want to get too far in the weeds, but 6206 equals 23,106. So that gives you an idea that the S&P is a bit stronger recently than the NAS is, just because the S&P is trading above that 6206, which equals 23,106. However, we have to keep in mind that since the lows of April, the S&P was 4834 and the NASDAQ was 16,480 or something. The NASDAQ has rallied 39%, the S&P's rallied 29%. So, they're just kind of catching up. So anyway, the point is that the big levels to pay attention to, macro levels that won't change, are 6206, and on the upside is 6402. We haven't quite reached that yet. We need to close, the S&P needs to close below the pit low last week, or the arch low of 6246, before we'll attack down to 6206. So 6246. Underneath there, that takes us to 6206, and then we can break back down to the quarterly pivot of 6010. So we've got a lot of room in the S&P for price movement. It's not going to be today. You don't need to make your fortune today. Look for today. I'll post the opening ranges on Twitter. Look for short breakouts, out of the opening range. Remember, 5 points in the S&P, 5 points on a four lot is $1,000. 12 points on a four lot in the NASDAQ is $1,000. $1,000 a day keeps the full-time jobbers away.
So we've got some cool stuff coming for PAX, everybody, opening range indicators and things of that nature coming to NinjaTrader. So make sure you stay tuned for that on PAX's segments. And of course, PAX is going to be on with me a lot more often coming up in the future. And we'll end there this morning, PAX.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.